On Wednesday, the United States quietly went past $40 trillion in debt, months earlier than anyone said it would. Split across every household in the country, your share of that is about $300,000. And the interest alone, just the rent on the money, not a penny of it paid back, now runs somewhere around $7,500 a year per household out of money you already earned and already paid tax on. Almost nobody noticed. And the reason almost nobody noticed is that on the very same afternoon, the Treasury did something to make sure everybody was looking somewhere else. It didn't work. It lasted 48 hours. Here's what I want you to hold on to for the next 20 minutes. There is one number in this story, and it is not the 40 trillion. 40 trillion is the headline. It's the number they put on the chyron. The number that actually decides what the careful half of your savings is worth is much smaller. Almost nobody says it out loud in plain English. And this week, it moved the wrong way in 2 days. I'll name it before we're done, and once you have it, you'll never watch a Treasury announcement the same way again. I'll also tell you why that one number is the reason I own Bitcoin. Because it's a number Bitcoin does not have and cannot have. But we have to earn that, so let's earn it. Let's start with the 40 trillion, because the shape of it matters more than the size. 10 years ago, that number was under 20 trillion. It has more than doubled since, in about the time it takes a kid to go from kindergarten to a driver's license. And what got the bond desk's attention wasn't that it happened, it's that it happened early. The forecast had this crossing months from now. The Washington Post's framing was that the debt hit 40 trillion faster than investors expected. When a number beats its own schedule, the thing generating it is running hotter than the people modeling it believed. I have a dashboard that watches a handful of numbers like this around the clock. The 30-year, the 10-year, gold, Bitcoin, all on one screen, and it emailed me the morning this crossed. I'll tell you which number on it I'd want you watching in a few minutes. It's not the 40 trillion either. Now, here's where Wednesday gets strange. Within hours of that milestone, the Treasury announced it was doubling its bond buybacks, buying back its own debt, old bonds off the open market with cash. Now, buyback sounds like a plan. Let me tell you what it actually is, in kitchen table terms, because the word does a lot of hiding. Imagine you owe money all over town, and the guys you owe start wondering out loud whether you're good for it. So you buy back a few of your own IOUs, not to clear the debt, but so the neighbors see somebody bidding for your paper. You're not paying anything off. You're buying the room's opinion of you. That's a buyback. So the debt crosses 40 trillion, the lenders start charging more, and the response is to buy back some of its own paper? Fine. How much? $4 billion. Dollars. Hold those two numbers next to each other, because this is the whole video in one comparison. 40 trillion of debt, a $4 billion response. 4 billion against 40 trillion is $1 for every 10,000 you owe. And it's worse than that, because the buyback doesn't operate against the whole debt, it operates in the market where these bonds actually trade. And that market is about $32 trillion deep. 4 billion against 32 trillion is $1 in 8,000. Jeffries put it politely. Against a market that size, the purchases are too small to alter the balance between supply and demand in any meaningful way. Let me say that the way a normal person would. It's a swimming pool, and they showed up with an eyedropper. And I want to be careful here, because the eyedropper is not the point. If they'd shown up with a bigger dropper, we'd be having a different and worse conversation. The point is that they reached for a dropper at all. Healthy borrowers don't manage the room's opinion of them. They just pay. For about a day, it worked. The rate on the 30-year government bond, the price America pays to borrow for 30 years, dropped about 10 cents on every $100, from roughly 5.35 down to 5.25. Headlines went up. Somebody exhaled. By Thursday, it was gone. All of it. The rate climbed right back to 5.251%, and the 10-year climbed too, to 4.7. Bloomberg's own headline that morning: U.S. 30-year bonds erase gains from Treasury's buyback surprise. Their read on the whole exercise, in their subheading, was that Besson's plan was, at best, a circuit breaker. CNBC put it plainer: the rally fizzled out. And 5.25% is just a sound until you place it. The last time America paid this much to borrow for 30 years was before the crash, before the bailouts, before 2008. So, the debt crossed 40 trillion, the government tried to buy the room's opinion, and the room handed the opinion back in 2 days. Now here's the part that should stop you mid-coffee. Because a failed intervention is embarrassing, it is not dangerous. This one is dangerous. And the biggest bank in America said so out loud in writing this week. JPMorgan's rates team, led by a strategist named Jay Barry, put out a note on the buyback. They didn't say it wouldn't work. They said something much worse than that. Their words: absent real fiscal consolidation, we fear the markets will view this action as lacking credibility. And then the line that is the actual story: this could contribute to higher term premium and yields over time. Higher, not lower. JP Morgan's warning is that the rescue makes the problem worse. Now, I promised you one number, and this is where I pay that off. Because term premium is that number, and it's been hiding behind a piece of Wall Street dialect this entire time. Here's term premium in English. When you lend somebody money for a long time, you charge them two things. You charge them for the time, you can't use your money while they have it, and you charge them a little extra for the doubt, the nagging feeling that a lot can happen in 30 years and you're not entirely sure this guy is good for it. That second piece is term premium. It is, literally, the price of not fully trusting the borrower. It's the same instinct you already use. Two guys ask you for a loan. One's your brother-in-law who has paid you back every time. The other one is your brother-in-law who has not. You don't charge them the same. The difference isn't math. The difference is trust, expressed as a number. So read the JP Morgan sentence again with that swapped in. What America's largest bank told the United States Treasury this week is, because you tried to manage the impression instead of fixing the arithmetic, the world may start charging you more for the doubt. That is not a market call. That's a credit downgrade written in manners. And the reason they use the word credibility instead of the word trust is that credibility sounds technical, and technical things don't frighten people. Trust does. Let's do what this channel does and count it at your kitchen table. Start with the careful half. Somebody told you a long time ago to move money out of stocks and into bonds as you got closer to needing it. That was reasonable advice. Nobody lied to you. But bonds have a seesaw in them that nobody explains at the time. When the rate on new bonds goes up, the older bonds you already own are worth less. Nobody wants your 4% when they can walk across the street and get 5. The bond doesn't default. It just quietly gets marked down. The rule of thumb for an ordinary bond fund: for every 1 point that rate climbs, about $5,500 goes out of every 100,000 you hold. A retiree with 500,000 split the usual way: 60 in the market, 40 in bonds, watches roughly $11,000 leak out of the side he was told was safe per point. And on the long bonds, the seesaw has a much longer plank. Somebody who bought the safest thing America sells back in 2020, when it paid a little over 1%, is looking at roughly 45 cents on the dollar today. $100,000 of the safest asset on earth, worth about $45,000 now. Nobody robbed him. There was no scandal. The math did it, in daylight, while he wasn't looking. Then there's the interest bill. America now pays more than $1 trillion a year just in interest on this debt. More than the entire Medicare program, and in the neighborhood of the whole defense budget. About $24 billion a week, $3 billion a day. Spread across the country's households, that's roughly $7,500 a year out of yours for a loan you never signed and absolutely co-signed. And it hits your kids on the way through. Mortgage rates track this same long end. Every tick up at these options is your son or daughter paying a couple hundred more a month for the same house. That 30-year rate, 5.251%, is the exact number I don't watch manually. My macro command center emails me the morning it moves. I want to tell you two short stories, because I've had a seat inside two of these. In 2001, I was working the phones in Phoenix, at 18th Street and Camelback, for MCI WorldCom. After 9/11, the telecom world fell apart, and my employer went down in what was then the biggest accounting fraud in American history. I learned early what happens when the people running the numbers lie about the numbers. So I walked down Camelback Road and got hired at a Honda dealership off a now hiring sign. Why Hondas? I like Hondas. Then in 2006, I got into mortgages. And on about my second day, somebody sat me down to teach me the product making everyone rich. Pick-a-Pay. Advertise a 1% payment, charge closer to 10, roll the 9 points you didn't pay onto the back of the loan, and justify the size of the loan against what the house was predicted to be worth later. I came out of car finance, where we lent against the lower of what the car sold for or what it appraised for, and we didn't cheat either direction. So I asked the only question I had. Wait, you're letting them borrow the future value of the home? I wasn't a prophet. I just refused to unknow the arithmetic. 2 years later, that loan book helped take down a bank. Here's why I'm telling you. In both cases, the tell wasn't the fraud. The tell came earlier. It was the moment the institution started managing what people believed about it instead of fixing what was underneath. That is the exact thing that happened on Wednesday. The debt crossed 40 trillion, and the response was an announcement. There's an old habit I've never lost. When a guy told me mortgage brokers were making $300,000 working 40 hours a week, I said, that's gotta be fake. And then I made him show me an actual pay stub. Numbers are yes or no. 1 plus 1 is definitely 2. There's no gray area. So don't take my word for any of this. The JPMorgan note is public. The Treasury's own buyback schedule is public. Go run it. And that habit is the entire reason I ended up here. Years before anybody on television said the word Bitcoin out loud, a client walked into my office to buy a condo in Scottsdale, and about $500,000 of his down payment was in Bitcoin. The underwriter refused it. Not because a rule said no, because she'd heard the word Bitcoin and she treated it like drug money. So I didn't argue. I showed her what Bitcoin actually is. A ledger, a record of who has what. Except instead of sitting on one company's computer where you take their word for it, this one is public. Anybody can read the whole thing. She checked it herself and cleared the money. That's the whole argument in one afternoon. The objection to Bitcoin was that it couldn't be verified, and the Bitcoin was the only thing in that transaction that could be. Her bank statement was a PDF somebody printed. The Bitcoin was a public record she could audit herself. Verification beats suspicion. It always does. Same test I'm asking you to run on the Treasury right now. And this is where the whole thing simplifies, because a number that big only has 3 exits. Door 1. Grow out of it. Out-earn the debt. Except the country is running a deficit of about 6% of everything it produces, while employment is full. That's the part that should land. 6% deficits are what you run in an emergency. There isn't one. This is the good weather. Door 2. Tax out of it. JPMorgan puts the funding need above $3.5 trillion in the coming years. There's no tax that closes that without a political event this country has never survived. Door 3. Print out of it. Make more dollars, pay the old debt with weaker ones. No vote, no headline. And you don't get a letter when it happens. Nobody in Washington will announce Door 3. They don't have to. The bond market voted on it this week, in public, in 48 hours. And the vote was to charge America more for the doubt. And notice what all 3 doors have in common. Grow, tax, or print. Every one of them is somebody in a room choosing what the money in your account will be worth. There is no exit from 40 trillion that isn't a committee. Bitcoin's entire pitch is that it took the committee out, not made it smaller, not made it more honest, took it out. And let me be honest about the counter argument, because somebody would find it in 4 minutes anyway, and they'd be right to. A buyback is not money printing. It's paid for with regular borrowing, it's small, and the Federal Reserve isn't involved. All true. And that's exactly the point. This wasn't the printer. This was them showing you they're worried enough to reach for a tool. The dropper comes before the hose. Now hold that next to what they're actually building. They are moving everything onto digital rails. Tokenized treasuries, tokenized funds, tokenized credit, tokenized property records, tokenized deeds. This isn't a theory, it's a construction schedule, and it's happening in public with acts of Congress attached to it. And when everything reprices onto those rails, one question survives all of it. Which one of these has no issuer? Because a tokenized bond still has a treasury that can print more of them. A tokenized house still has a county registry and a tax man. A stablecoin still has a company. A digital dollar still has a committee. Every single door they are building for you has a man standing behind it who can make more of the thing. Every one of them except Bitcoin. That's what this week was actually about. $40 trillion of paper and a $4 billion attempt to manage what the world thinks of it. Bitcoin has no such lever because Bitcoin has no such man. 21 million. Fixed. Forever. No servers, only a protocol. And let me be precise, because fixed supply gets said so often it stopped meaning anything. There is no Bitcoin secretary. No Bitcoin auction where the world shows up and decides what it costs this year. No Bitcoin buyback because there's no issuer to do the buying. When America needed somebody to bid for its paper this week, it had to be America. Bitcoin never needed a buyer of last resort because it never had a seller of first resort. Nobody announces a Bitcoin buyback because there's no issuer to announce it. Nobody manages Bitcoin's credibility because there's nobody who has any credibility to manage. There is no term premium on Bitcoin, no price of doubting the borrower because there is no borrower. The supply doesn't respond to a bad week, a bad auction, or a nervous Treasury secretary. It just runs. And I don't say this because Bitcoin went up this week. It did. It had its best week since 2023. And that is not the reason, and it never has been. Bitcoin's argument this week is the same as it was the week it fell. The number of them cannot be changed by anyone who is having a hard year. Here's the frame that took me the longest to arrive at, and it's the one I'd hand you if I could only hand you one thing. Change the denominator, and it changes the equation. We measure everything in dollars, so when the dollar gets weaker, things look like they're going up. Your house looks like it's worth more. The market looks like it's making you money. The debt looks like it's exploding. Price the same things in something that can't be made more of, in gold, in Bitcoin, and the picture inverts. Half of what looks like growth turns out to be the ruler shrinking. That's how Bitcoin actually got me, by the way. It wasn't a price chart. I started pricing houses in gold and in Bitcoin instead of in dollars, and the houses were getting cheaper. They were only going up when I measured them in the thing being made more of. 40 trillion is only a scary number in dollars. Measured in Bitcoin, it isn't a number at all. Because there is no version of this story where somebody makes more Bitcoin to cover it. That's not optimism about Bitcoin. It's the one rule Bitcoin has that the dollar doesn't. I'm not telling you what to do with that. There are no certainties here, only probabilities. And anybody selling you certainty is selling you something. I'm one guy offering a perspective and the reasoning that got me there. You're free to land somewhere else. I just ask that you don't take the official story on faith. I've now watched two institutions manage the story right up until the arithmetic came due. The debt crossed 40 trillion on Wednesday. Their answer was 4 billion. The market gave it back in 48 hours, and the biggest bank in the country said the answer itself makes the trust problem worse. That's the whole week, and the exit is still open. If you want the same live numbers I just walked you through, the 30-year, the 10-year, Bitcoin, gold, all on one screen, take the 2-minute money quiz at timtalksfinance.com/members. It's free, no credit card. It shows you your net worth in one place, what inflation is quietly costing your cash in actual dollars per year, and one move worth considering for your situation. I built it so you don't have to figure this out alone. I'm Tim. Do the math yourself, and the official story falls apart. I'll see you in the next one.